Welcome back to episode 2 of the Trading with Trend core learning series. In this episode, we're going to talk about choosing a pair, choosing a time frame, choosing a time session, and understanding and calculating risk per trade. All of these are super crucial components to becoming a profitable trader, and you need to take note and caution with every single part of this video. First, we're going to talk about different pairs, which pairs you should trade, whether it's Forex pairs or indices. Next, we're going to talk about the time of day or your session that you're going to trade. Then we're going to talk about which time frame you should trade on, the 1 minute, the 5 minute, the 15 minute, the 1 hour, etc. And finally, we're going to talk about calculating your risk size, how to do that, and what that means. Okay, so we're going to start off with which pair that you should trade, okay? There's several different major pairs and several different major indices. The difference between a currency pair and an indice is simple. A currency pair is trading two different currencies. For example, you can see on my screen that you have EUR USD, USD JPY, GBP USD, okay, etc. These are currency pairs. You're trading the US dollar versus the euro, the US dollar versus the Japanese yen. You understand. Then there's something called indices. Indices are essentially like stock market ETFs. The major indices that most people trade is the US 30, the US 100, and the US 500. What those are is it's the top 500 US companies, the top 100 US companies, and the top 30 US companies. So you're trading basically stocks of companies that make up market caps in major countries such as the US, the UK, the EU, and Australia, versus Forex pairs where you're trading, currencies. One of the major differences is that when you're trading Forex pairs or currency pairs, you're dealing with like 0.0001 decimal place of change. Whereas when you're trading indices, you're dealing with multiple dollars, tens, or even hundreds of dollars in change. Forex pairs is you're trading currencies, and indices is trading groups of stocks that make up the major companies in major countries. And another really cool tool here is this currency strength meter by Baby Pips. It allows you to see which currencies are strong and weak on any given day. Since we are a trend scalping group here and strategy, a lot of the times if you pick a strong currency and pair it against a weak currency, as long as it's a major pair, you'll likely see a trend there. So I like to trade for trend scalping. I only trade indices, but trading Forex pairs is perfectly fine. To figure out what you want to trade, you can trade any major indice or any major Forex pair, but what you need to do is you need to line it up with your session time. So when are you trading and when is that pair often traded? You only want to trade indices or major Forex pairs during the time of day that everybody else in the world is trading them and they have high liquidity. So that brings us into our next topic. Which session are you going to choose? And that brings me into another really nice tool here, again, by Baby Pips, and that's the Forex market hours. So you can see here that it will show you exactly which hours are trading each day. If you are trading, for example, the NAS 100 like me, then you would only trade during this New York session in this green bar. You could trade anytime in this New York session. If you're trading currency pairs, and let's say you're trading USD JPY, then you could trade during the Tokyo session or the New York session. Let's say you want to trade USD and AUD, right? USD is strong right now. AUD is weak. If you wanted to trade that, you would trade during Sydney session or New York session. To choose which pair and which time frame you are trading, they are kind of locked in together. You want to trade a pair where you can trade consistently every day their major hours. If you live in the US, your best bet is to try to trade any US currency pair here in New York session. If you can only trade in the middle of the night US time, then you want to find something that's going to revolve around the Tokyo or Asian session. So you're going to want to look at pairs that involve JPY, maybe USD JPY, and then you would pick that at nighttime. Or if you can for some reason only trade early, like very early in the morning, you might look at a GBP pair to trade London session. To summarize this and move on to the next segment, we will end it with this. To find your pair, you need to understand what time of day you can consistently trade. Once you understand what time of day you can consistently trade, you're going to come to this market here and you're going to figure out which sessions are open during the time that you can trade. Once you understand which session you're going to be trading, you're going to look at major pairs or indices that trade during your session, and that is the best pair to trade. Okay, so now let's talk about which time frame to trade on. There's several popular time frames, as you can see here. With scalping, most people like to scalp in between the 1 and the 15-minute time frame. Anything longer than the 15-minute, I would consider it would be used for swing trading and not really scalping. But there's people who scalp larger time frames. I like to scalp the 2-minute. That's my bread and butter, but it might be a little bit too fast for some people. The 1-minute is also very, very popular, but again, it's very fast moving and it's hard to get great entries. For a beginner, I would recommend either the 3-minute or the 5-minute. The 5-minute is generally what a lot of you guys, if you're new to Forex trading, should be looking at. Anything faster than the 5-minute might be moving a little too quick for you guys to read the chart and get in good positions. You never want to rush an entry, and if the price is moving like crazy because you're on a 1, 2, or 3-minute time frame, then it could get a little hectic, which could mess with your mind and lead to some bad trades. So to kind of clarify, if you're new, check out the 5-minute. Once you get a little bit of experience, move down to the 3-minute. And the 3-minute is good to stay at forever. And if you want a little bit more action, you can move down to the 1 or the 2-minute. The final thing that we need to talk about in this video is calculating our risk size, okay? This is arguably the absolutely most important thing in all of trading altogether. It all comes down to this. If you mess this up, you'll never be profitable. I can't stress that enough. This is the most important thing that you can focus on, that you can hear. This is it. Everything else doesn't matter if you cannot complete this building block right here. And that is calculating your risk, all right? So there's a few tools online you can use. They look like this. There's also a tool that you can use, which I'll link below. So let's just take a look at this. So when you enter a trade, you should never be risking more than 1% of your portfolio size. Let me repeat that. When you are entering a trade, no matter what happens, you should never lose more than 1% of your account at a time. The only caveat to that is if you're trying to pass a funded test and you have a direct plan that says maybe you are risking 2% per trade. Other than that, you would never ever risk more than 1% of your account at a time. So in order to never lose more than 1% of your account at a time, you need to be able to calculate how much lots you're going to purchase with where your stop loss is going to be set to make sure that you're never losing more than 1%. So if you see here with this online calculator, and this is the kind of annoying way to do it, you could say, all right, my account balance is 50%. I want to risk 1%. The price right now is at $12,014, and I'm going to set my stop loss at $11,773 on the NAS 100. It's going to tell you that you can risk 2 units at this 2 units or 2 lots with your stop loss here. And the worst thing that'll happen is that you'll only lose 1%. If you're trading Forex, there's this website here. You could say you have $50,000 in your account and you want to risk 1%, and you're going to take a 15 pip stop, calculate, all right, you're going to trade 3.3 lots, okay, and you're going to set your stop loss 15 pips down. If this isn't making too much sense to you, let me show you on an actual chart, okay? This is NAS 100. I have around $46,000 in this account, and you'll see I have a risk percentage of 1%. I want to set my take profit at 1.5, and you'll see this is my stop loss line. So wherever I set it, it will make it so that I'm only ever risking $454, which is 1% of my account. All right, this take profit doesn't matter too much when you're calculating risk. What matters is your stop loss. You want to make sure that when the price reaches your stop loss, you are only losing at maximum 1% of your account. So you need to be able to calculate how much, okay, you're going to risk. So let's say we opened a new trade. How much volume are you going to risk to where when the price hits your stop loss that you only lose 1% of your account? That is what calculating risk is. You never want to risk more than 1% of your account, so you need to make sure that you're using a calculator or a EA to calculate your risk and make sure that no matter what, you can only lose up to 1%. Once you've figured out which calculator or extension that you're going to use to do this, you need to come up with your trading plan to understand how many losses in a row you will take. For me, I will never take more than 2 losses in a row. If I take 2 losses in a row, I am done for that trading day, and I will move on and wait for the next day. That is what calculating risk is all about. 2 things. The first thing is about actually calculating your risk per trade to make sure that you're never losing more than 1% or whatever the percentage in your plan is. And the second step is understanding how many losses that you will take in one day before you quit trading to make sure that you never draw your account down more than X percentage in one day. So in this video, we covered which pairs or indices you might trade, which session of the day you might trade, which time frame on your chart you might trade, and how to calculate your risk and understand how much risk to take per day. In the next video, I'm going to teach you how to identify when your pair is trending. We have a 100% free indicator that will help you identify and mark up your chart when there's a trend. And again, in the next video, we will teach you how to install this indicator and how to spot these trends and possible trade opportunities. Thank you for watching, and I hope to see you in the next video.